Good afternoon, everyone. It is my pleasure to welcome you to this webinar where we'll be discussing the decarbonization in the shipping industry. I'm Alessandro Sanos, the Global Director for Commodities and Strategy at LSEG. And climate change is triggering policy change, and a new regulatory framework is emerging. So today, we'll be exploring the anticipated impact of the forthcoming regulations, the dynamics of the carbon market, and the measures that the maritime sector can take to reduce emissions. But before we start, allow me to quickly present you today's speaker. Geir Olafsen, co-founder at Siglar Carbon, Professor Nikos Nomikos from Bayes Business School, Hege Thielheim, Director of Carbon Research at LSEG, Captain Amrit Singh, our lead shipping analyst, and Fabrice Mail, our Director of Commodities and Shipping Product. So without further ado, let me open the discussion with a question that will help us set the context. So Captain, what is the regulatory landscape from the shipping perspective?
Thank you, Alessandro, and hello, everyone. Welcome to the webinar. With regard to shipping, shipping contributes almost 3% of the greenhouse gas emissions annually. And the International Maritime Organization and the European Union have been working on it for reducing for the past few years. And what is looming on the horizon is that in 2023, from the IMO perspective, we have the Energy Efficiency Existing Ship Index, which is EEXI, coming into play from the first periodical survey of the vessel. And this is a technical measure. Along with that, we have the carbon intensity indicator, which is an operational measure. And IMO had a ship energy efficient management plan. With that, part 3 comes into play, which looks at the carbon intensity indicator and how to go about for the next few years, because the rule is going to be tightened by about 2% every year. On the EU front, EU has proposals for Fit for 55, which my colleague Hege will speak more about it. But the proposal from the maritime aspect is to bring the emission trading system, where maritime is part of the current emission trading scheme in the EU. The other important thing is that there is an energy taxation directive, which was part of this Fit for 55, which is proposed to be brought in. Under this, the exemption on the fossil fuels, which is currently in place, is going to go, and the fossil fuels are going to be taxed on a 10-year transition period basis for the intra-EU. However, the member states have the option to look at the international ships which move into the zone to look at how they would tax them. So that means that on the fossil fuels, if it is gas oil or heavy fuel oil, the tax would be higher as compared to, let's say, the LNG or the LPG, and it will be very low on the sustainable fuels going ahead. So I think what is important is that the IMO is looking at the international perspective and going at a speed whereby in 2030, they would want to reduce the carbon intensity by about 40%, but the EU would like to reduce that by 55% by 2035. Thank you, Alessandro.
Thank you, Captain. And Geir, what is the role of charterers in the decarbonization of shipping?
The charter's role is, of course, crucial. I mean, in the end, all costs that we will have on decarbonizing or reducing emissions from shipping, one way or another, needs to be reflected in freight rates. And of course, that's what the charterers are paying. They are the ultimate customers in our industry. But the charter is also crucial because they also have a lot of decision power that dictates how much emissions a ship's voyage will end up with. Before the ship is even selected, there are choices that the charters are making that has the biggest impact. So you could actually say that the charter's actions are the ones that would have the biggest impact to reduce emissions. For instance, it's the charter or the commodity deal that dictates whether the voyage will be a short haul or a long haul voyage. Obviously, a short haul voyage would result in less emissions than if you move the cargo to a longer haul destination. And secondly, it's also the charter that holds the power to choose. When the charter goes in the market via his broker, the charters receive a lot of offers, normally receive several offers from various ships that can do or have interest to transport his cargo. So again, here the charter can, if the charter are aware of the expected emissions for each alternative, the charter can also then achieve the most, even by just selecting the right candidate with the lowest emissions, rather than just selecting on commercial terms alone. Of course, commercial terms do have to play a role here, but again, bringing the emissions and the expected emissions on the table for the charter has ultimate decision power to again achieve a lot of reductions already before the ship has started sailing to pick up the cargo. That being said, I mean, it's not only the charter that has this as an opportunity. I mean, this is also an opportunity from an owner's perspective. The owner, when emission is becoming a factor in the day-to-day way we trade and fix ships, the owners can also challenge the charter. Listen, I have the best position here. I have the ship that will have the lowest emissions. You should select my ship. And that way you can play the market, use the market to end up with a solution that just by the commercial decisions actually achieves quite a lot of reductions in overall emissions. So yes, the charter's role is crucial, but it's also an opportunity also for the other ones to challenge the charters to make the right decisions so that we all can end up with the best and lowest emitting alternatives for the next cargo that we are looking for.
Excellent. Thank you. And Hege, coming to you, what is the status for the Fit for 55 discussions? And what are the implications for the shipping sector inclusion in the EU emissions trading system?
Thanks, Alessandro. Hi, everyone. Yeah, I'll try to answer that and discuss a bit where we are in the Fit for 55 discussions. Let me show you a couple of slides, just first to set the context of what really is Fit for 55 and how does shipping fit into all of this. So, hang on. So, I mean, Europe has a carbon neutrality target that is now set in the European climate law for 2050. And also the 2030 target, which is a reduction by at least 55% compared to 1990 levels, is also set in the European climate law. And to get to that reduction, the European Commission proposed a package of legislative proposals last July, which is in short, Fit for 55. So it's really the term for a huge monster package of legislative proposals that will lead Europe to reach this climate ambition or emission reduction target by 2030. So it has this emission reduction target. There's also proposed targets for renewable energy, for energy efficiency. There are national climate targets per each EU country. And one of these files is regarding the EU ETS. So that is a proposal to revise the EU emissions trading system, which is the flagship instrument to decarbonize the European economy. It covers now, I think, 40% of emissions. But the idea is to expand the scope of the EU ETS and of emissions trading overall. So it will be including more sectors in the current EU ETS, which now covers power, industry, and intra-EU aviation. And also the proposal is to create a separate ETS for buildings and transport. So really covering a much larger part of the European economy. So this is the proposal from the European Commission. And how it works, I mean, the European Commission does a really thorough job in these legal proposals, and they're backed up with impact assessment, lots of scenarios, and there's one proposal picked and put forward then to the lawmakers. So that's the European Parliament and the European Council. European Council are all the member states, and together these two lawmakers will have to agree on the final outcome, and that will become the law on the EU ETS and on all these other files. So right now, or like since the European Commission put forward this package in July 2021, there's been a process within the European Parliament, all the committees discussing the different files, and also the same between the member states in preparing their position and haggling between the different countries to come up with a council position. And that is now ready. And the current phase we're in is this trilogue phase, which is which is less formal. It's negotiations between representatives from the European Parliament, so the rapporteurs of this file, and the presidency of the European Council that is leading the file at the moment. So we're in this trilogue phase. I know the plan was to have the Fit for 55 agreement ready by COP, but that starts on Sunday, so that was not. It's been clear for some time that was not going to be possible. But the talks are quite advanced on the different files, and I think there is expectation to that at least the EU ETS file could be ready by early next year. So then it will become then everything will become clear on how this will end up. Because right now for shipping, it is I mean there are some inconsistencies in between what the Commission proposed and what the Parliament and the Council have as current positions, but I think overall it's not such a big difference. The main thing is really the timing for when shipping will be covered by the EU ETS, where the European Parliament normally is a bit more impatient than the Council and the Commission, and is proposing an earlier start. So this is, I would say, is the main difference, and we'll have a full understanding when these trilogues have been completed, probably by the end of the year or a bit into 2023. Yeah, so this is really just summing up. Right now, you know, we have utilities and industry and intra-EU aviation covered by the EU ETS. Utilities and industry from the start in 2005, and aviation coming in 2013, I think. While shipping then is expected now mid this decade. You also have another player or group of players in the carbon market, which is the financial sector, banks and hedge funds that will provide liquidity in the market, and also banks are typically acting as intermediaries for smaller companies in industry, for instance, helping them to ensure their compliance with the EU ETS. Because what they will need to do is to once every year make sure that they have enough allowances, which is really a permit to pollute, representing 1 ton of CO2. So they will have to hand in the permits for the previous year's emissions, and it is different how these different groups of actors are acting in this market, depending on their size and their positions. So just really simplistic, utilities are buying allowances on auctions and more active in the secondary market. Industry has historically received most of their allowances for free. So they have been historically been less active in the market, while utilities are hedging and being more active. And the shipping industry is set to also be completely have to get their allowances on auction. So in a way, it's entering a new world of carbon market where you need to understand your position, and you need to understand how to optimize your book as best as you can for the next year's compliance and even further ahead. I think I'll stop there for this first question.
Thank you, Heike. So it is coming.
It is coming.
It is coming. And if we move now towards the challenges, Nico, what are the main obstacles towards the drive for decarbonization?
Yes, thank you, Alessandro. There are a number of, I believe, fundamental constraints that, to a large extent, reflect the way shipping markets are organized. At the core of the issue is the cost issue, in the sense nothing combines the power, cost, and efficiency and savings of fossil fuels. There is therefore a significant cost element, and that is an element that has to be borne by the ship owners. Now, how this cost is filters or trickles down, if I were to use an economic term, into the other participants in the industry, to a large extent reflects the structure of the sector. And I believe this is where some of the obstacles lie. So I have identified 4 of these obstacles. The one that is also widely reported in the literature, and it is also something that practitioners agree, is what we call in economics misalignment of incentives. So this is a textbook case where the incentives and the benefits of the ship owners are not fully aligned with the benefits and the incentives of the charterers, who are the main users of the freight. So in a sense, the ship owners will have to burn the cost of renewing their fleets and making their vessels more environmentally friendly, but it is also the users of the freight service that will be bearing the main benefits. And this creates a lot of obstacles and, if you like, conflicts between the 2 aspects. There is also a related issue in that respect, which is that there is only a partial pass-through of costs from the owners to the charterers, and this further creates distorted incentives that do not encourage investment in new technology and also investment in new fleet capacity, which is really where the core of the issue is. Second obstacle has to do with the fiercely competitive nature of the industry, and as with any other competitive industry, the default modus operandi of a ship owner is to drive down costs, is to be as cost efficient as possible in order to survive the very volatile and highly cyclical freight markets. Ship owners are quite adept in doing that, but at the same time, within that environment, looking at further technological changes and accommodating these changes has to be part of the agenda as well. The third aspect is that we're talking about a fragmented industry, and I have in mind here particularly tramp shipping. Container shipping is slightly different, but particularly in tramp shipping, you have the very low concentration of ownership. Something like 70% of the industry controls fewer than 20 ships, and even if we look at the largest ship owner, they control less than 2% of the world's fleet. So within that environment, the emphasis is mostly on cash flows, cost innovation and reduction, and again, surviving the cycles and having strong financial performance. So in a sense, shipping companies have long prioritized cost control over commercial and technical innovation. And again, this is something that will need to change, if you like. Now, as a side note on that, what is interesting is that it is traditionally these highly fragmented industries that are most amenable to a disruption, to some sort of technological disruption that can change radically and drastically the way the industry operates. And the fourth item, which is ever important, is that we're talking about one of the most volatile and risky asset classes. Looking at the volatilities of dry and tanker freight rates, they are a multiple of the volatilities of the commodities that these ships transport. So within that environment, it is very difficult for even the most sort of experienced owner or operator to make any forward prediction and forward planning. And if you compound into that the fact that we're talking about uncertain and unproven technologies, this compounds the problem even further. So what we see right now, I think, is what you may call an ESG-induced hesitancy to invest, driven mostly by the large uncertainties on the E side of what ESG stands for. So although there is currently, if we look at the order book, a large number of the order book takes into account either dual-fired, dual-fuel ships or LNG fuel ships, still that level of order book does not fully reflect the potential trajectory of where the shipping fleet should head going forward. So just to conclude that part of the analysis, I think one way forward would be a market-based mechanism, very much similar to a trading scheme where emissions from shipping will compete with emissions from other sectors. That will provide a very clear price benchmark as to what emissions are caused, and that will incentivize investments. It will create a much more clearer picture of what the returns on investments are and what are the costs from the users of that service. So these are my thoughts.
Ευχαριστώ, Nico. And
Thank you.
At LSEG, we say that data is always the beginning, so we'll be diving into that as well. But until the next question, I would like to remind attendees that they can ask questions. So please do put your questions in the chats, and we'll have a Q&A session towards the end of the webinar, where our distinguished speakers will be able to answer to your questions and to your thoughts as well. Going back to data, Fabrice, how decarbonization is likely to reshape the maritime data and analytics industry?
Thank you, Alessandro. Hello, everyone. Yeah, that's a good question. So in the same manner, we had IMO 2020, 2 or 3 years ago. Decarbonization comes with its share of data and analytic needs. The difference, of course, is that when IMO 2020 was sorted out rather quickly, decarbonization is likely to keep us busy for the next decade. It's an obvious statement to say that maritime industry is becoming more and more data-centric. It is estimated that 50% of decarbonization gain required to meet the 50% reduction at the horizon of 2050 will have to come from operational efficiencies on existing ships beside new fuel technology. And if we talk about CO2 estimation, voyage optimization, vessel optimization, they all require access to what I would call internal data, but quality data, granular data, sourced from, for example, real-time sensor, flows meters, and reported via, I would say, more holistic, harmonized, and digital noon reports. So the first consequence of all these things is, of course, this implies decarbonization rely on further digitalization of ships, ports, and cargo movement. The second aspect I would like to insist on is transparency. Transparency of the data collection and reporting related to ship carbon emission. This is a key aspect of decarbonization, and especially for the investors. This is typically currently the case with EU MRV data, but it's not the case with IMO DCS data, which is aggregated. The third point I would like to raise is the way we access the data. Another obvious statement is, of course, maritime data needs to be available on API because, especially we see this very well with our client, they want to commingle these internal data with external data in data management systems, data lake, and they're coupled with machine learning model, predictive analytics, geospatial analytics. But under this umbrella of decarbonization, the data and the analytics can ultimately serve different use cases. Of course, the compliance with the IMO EU ETS. As Geir mentioned, the data power the prefixture decision. So this is also encouraging low carbon commercial decision, or this is also to assess the emission cost exposure. The data power the bunker procurement, the data power the voyage optimization. When I say voyage optimization, well, we can think about steaming optimization, weather routing. There are now plethoras of services in this space. Powering the fleet renewal also. So, and all the data set supporting this decision can be also very, very diverse. Of course, they can be related to the ship performance, typically the data coming from sensor, bunker consumption. Of course, we need the carbon price, we need the carbon forecast. They can come from vessel location, AIS, radio frequency, vessel characteristics, speed, power, engine. Having an engine database is something critical today. Vessel valuation, steel price, the port congestion or port waiting time data, routing data, weather data, average speed, etc., etc. So also, under this umbrella, we see many different types of data, very diverse data. And last point, as I mentioned, we all need to keep exploring. This will keep us busy for many years. And what we notice in this space is that partnership, coalition, center of research, an ecosystem are very relevant, more relevant than in other space, and also make us and shipping different. Thank you, Alessandro.
Thank you, Fabrice. And Captain, I would like to come back to you. What are the near-term measures that ships can take to minimize emissions?
Thank you, Alessandro. That's a very interesting question. So ships typically spend about 70% or so, plus or minus, depending on the different type of ships, but I'm giving a general overview here, on time at sea passage. They spend close to about 15 to 20% of their time during port operations, and the rest could be spent at anchor or drifting or doing repairs, etc. So in terms of driving the carbon efficiency, the way that we could look at it is in some three forms, which is it could be the operational, the technical, and the market-based measures. And under operation, my colleague Fabrice has already alluded to the voyage optimization. But the key thing going forward would be the reduction of ship speed. And the reason being is that quite a few ships under the EEXI, which I spoke to earlier, once they get that certificate, they have within that the ability to limit the engine power or the shaft power so that they fall within the required limits for that particular design of ship. So on an average basis, we'll see a reduction of anywhere from 1 to 2 knots, depending on the type of vessel going forward, if it falls under the existing or the EEXI ships. Before EEXI, there was an EEDI in which the new builds were asked to become more carbon intensive. So we have a mix of ships which are already reducing their carbon intensity, and that may perform slightly better than what the existing ships were. Now, the other critical thing is trim and draft optimization by the vessel itself, and the just-in-time arrivals, whereby the ships, rather than going and waiting at ports, can adjust their routes so that they can, on the passage, use the main engine or the power optimally. And then you bring in the weather routing as well, whereby you're using the best route possible, whereby you avoid adverse weather where your engine consumption can go up. And the other sort of operational measure is, which is in the ship energy efficient management plan, as to how frequent you can do the hull cleaning, etc. And now there are robotic equipment available, which the vessels can use. So that is the operational aspect. Then we look at the technical aspect. On the technical aspect, the key thing is that it all depends on what the economic life of the vessel is, and what is the capex, the opex, and what is the return on investment or the payback period on the measures that we are taking. And that will decide on what the owners will go for. The options are bulbous bow refit, have good hull coating, which actually reduces friction and helps in that. Then there are certain systems available, which are the hull air lubrication systems, which blow air bubbles to reduce the friction so that the ship moves through the water much more efficiently. And then we have what we call the propulsion improvement devices, whereby you can use different types of propellers or adapt them, like contra-rotating propellers, etc., to get efficiency in the thrust that the ship gets when it is passing through the water. Then you have the shaft generators, whereby, I'm going a little technical here, but whereby the main engine is then driving the auxiliary engines or the generators on board rather than that energy going waste. Then the other interesting bit is, going to the earlier years, the wind assistance. So we have people looking at the rotors, people looking at kites, and even sails as well, which helps in bringing the efficiency, because these natural sources can be used to propel the ship forward. And then there are certain drop-in biofuels which are being available now, which could be used with the existing fuels. And then one could explore the fuel oil emulsion technology, whereby the mixture of different fuels, and this will depend on the engines, and the trial period will have to be taken into account, but they can be used to reduce the carbon intensity of the vessel. And the others are the onboard DC grid system, whereby the energy is then converted into a battery and then it can be used on board, or the waste heat recovery systems. But as I said, the key also would be the installation time, the payback period, and the verification as to what all these measures are doing along with the operational measures to reduce the carbon intensity. And the last is, there is a realization that not all operational and technical measures will be able to assist in hitting the targets, which the International Maritime IMO or the EU, or under the Paris Agreement, we are trying to hit the 1.5 degree temperature centigrade lift in the global temperature. So for that, market-based measures would have to be brought in, and that is where the EU emission trading system, or which is a cap and trade system, or the energy taxation will come in. International Chamber of Shipping is even proposing a maritime sustainability fund, whereby it is a fund and reward where a certain amount of fossil fuel, a flat rate will be taxed, and if the carbon intensity of the ship or the CO2 emission is lowered, you will be given, or the ship owners will be given, a reward for that. So I think all these measures should be seen in the spirit of reducing the carbon intensity and meeting the climate goals that are set in the Paris Agreement. Thank you.
Thank you, Captain. So hopefully we will start seeing again some of the ships with the beautiful sails that we've seen, some rendering online.
Yes.
Geir, coming back to you, how are charterers and owners preparing for the coming regulations, and how are these regulations likely to impact the market?
Yeah, well, it might seem like a myriad of regulations and initiatives out there. And to be frank, right now, there's no cost. In general, there's no cost for a ship to emit CO2, no direct cost. Of course, you pay for the bunkers, but there's no direct cost on emitting CO2. So right now, there's no economical direct incentive to reduce emissions. But of course, that will change with the EU ETS being the first one introduced on a global, that will have a sort of a global reach then sometime next year or within 12, 15 months. Okay, the key drivers, the key three initiatives coming, it's two from IMO and then the EU ETS. So if we start with the IMO, what's coming, it would be the CII and the EEXI. And Captain Singh mentioned the EEXI already. So what are they doing to prepare? Well, right now, most of the owners are busy with their classification societies, calculating which ships that they would need to reduce or limit the power and the engine power. So, and what impact will that have on the market? Well, for some segments, we're going to see reduced fleet capacity because some of the ships would need to slow down. Will it have an impact on the market rates? There is surplus capacity in some of many of the shipping markets today, and in some of them there is not. So for those segments that are in the upper part of the market cycle, we're going to see a direct impact from the EEXI, and we're going to see upward pressure on freight rates moving into next year, when we're going to see, for instance, older LNG carriers having to slow down, removing capacity from the fleet. We're going to see dry bulkers, some of the dry bulk segments having to slow down, removing capacity from the fleet, again, upward pressure on freight rates. Whereas other segments that are not that tight today might be able to absorb or that loss of carrying capacity. So the EEXI, that goes straight into the design of the vessel and the sort of the vessel specifications. The next one coming, and this one also comes into place January 1st, 2023, and it's mainly the owner's focus today. How will the carbon intensity indicator work out for my ships as I progress, or my ships progress trading through 2023? Because the owner would not probably, and especially not the investors and the banks behind that owner, would probably not like to see their ships being rated with an CII rating of, say, D or E, which is, of course, below what's supposed to be. So what kind of impact will that have on freight rates and in the market? Nikos, you mentioned incentives, and the underlying incentives from the CII is also debatable in the market today. I mean, there are some, the strength with the CII is it's easy to interpret, it's easy to see if a ship is an A, B, or C, fine, I can accept it. If it's not, then I would not. But the way that the CII is calculated is less clear-cut. For instance, the CII, a good CII, you would have a good CII if you have more long-haul voyages for your ship than short-haul voyages. So if you are primarily trading in short-haul voyages, you might end up, even with modern ships, to struggle to get a good CII rating. And I don't think that's the intention. Short-haul voyages, in the end, if you move cargoes shorter hauls, we reduce emissions. But the CII gives the opposite result. Furthermore, the CII does not differentiate whether the ship is carrying cargo or if it's ballasting. As long as the ship is sailing, the ship is rewarded with a better rating. And that also means that some of the lucrative trade today, from an owner's point of view, that where a ship ends up with a long port stay or on demurrage, that would also result in a poor CII rating. So for instance, we would probably likely see tanker owners more reluctant in 2023, or at least well into the year, be more reluctant to take on cargoes to West Africa, for instance, where they are on weeks on the merge, because it will have a direct impact on the CII. We're going to see the LNG carriers again that are on long waiting for quite some time outside European ports, because the stores there are quite full. We're going to probably see some of the Cape and dry bulk voyages as well. We're going to see owners being more reluctant for some of these voyages. And that, of course, is a consequence of the CII that might not be rational overall. But okay, it is an operational measurement, and the incentives and the use is, of course, are good, but it has some strange consequences in the way we derive that letter rating. So yes, a lot of questions around the CII and how that will pan out, especially then from an owner's point of view. What we believe is when you're negotiating that next cargo in the coming year, you should really understand if am I going to contribute to a better CII, or would I contribute to a worse CII? I think that would be an added information that will be brought into commercial discussions in 2023. Okay, I'll move on to the direct cost, the EU ETS. Let's have a look at the product tanker. It would emit, depending if you hit the spot, the best lowest emitting position and ship, or if you are on the upper part of the range. I mean, your emission, you can end up with between 900 tons of CO2 up to 3,000 tons of CO2. When this has some direct cost, I mean, today's EU quota is plus or minus $70. That range would mean, as you as a charter, that your trading margin would be impacted by somewhere between 80 cents and $2.8. Your time charter result as an owner, you would have an impact between $1,100 per day and $3,500 per day. And if you look at the forward price and assume that all EU eligible tons are paid for, and we use the forward price of Refinitiv, say by 2030 over 130, then we are looking at somewhere between $1.50 to $5 per ton product that the cargo charters is moving, that the traders are trading. It's going to eat into their trading margin, and the owner's time charter equivalent would also be hurt by $2,000 to $6,000 per day. So it's the first thing we're going to have a direct cost, and I think this, starting next year or whenever the EU ETS is into place, this is something every professional in the industry needs to have to include in the voyage calculations. When you offer for a cargo as through your broker, or the broker needs to understand the expected EU cost. And that would vary from ship to ship and cargo to cargo and day to day. So it's a very fluctuating and changing picture that's adding complexity to the market, but it's also creating opportunity for those that has the lowest emitting shipping alternatives.
And yeah, one question, because 1st of January is basically tomorrow. What is the level of awareness of ship owners?
I think they are very, well, ship owners and charters. On the CII and EEXI, obviously the owners have been very busy over the last half year preparing. And I think on the CII, I mean, they are already reporting sort of the similar numbers into the EU MRV and the DCS systems. But that added complexity with the rating and that incentive of not avoiding long port stays and keep the vessel sailing. Yeah, I think it's a bit wait and see. They're probably going to monitor the situation in the first few months, and then they're probably going to start reviewing, okay, which ship do I need to change from one trade into another? That's another aspect. You probably need to change a ship doing short haul voyages in maybe a steady program. You would have to redirect that ship into another trade and replace it with another ship that's not familiar with this trade. So it also adds some operational risk, I would say, as well.
Excellent, thank you. And Hege, what will be the future carbon cost for the maritime sector? What are the drivers for carbon prices, and what's your carbon price outlook for this decade, so a forward-looking view?
Yeah, good question. We do have a base case, but of course, we also do a lot of scenarios because there's so many uncertainties. But let me just have a look at the past before I go into what we predict for the future. So this slide is showing the European carbon price development since 2013. So you see for the past decade, we had really depressed prices in the UTS, below 10 euros, 5, 7. To understand, and then something happened. And to understand really this is a policy. This is a market that is created by policy. So it is kind of artificial in the way that the supply is created by the climate ambition. So it's really that is really the determinator for the supply side, and then the demand side, of course, emissions, which is fluctuating. And the idea is to set the target and the cap for the UETS with some long-term visibility. So that's why you have trading phases. So the third trading phase from 2012 to 2020 was set up front, and you had a target set up front and no flexibility on the supply side. Then you had the financial crisis. Emissions dropped because of lower economic output, but the supply remained the same. So hence you had these, that's the easy explanation of why you had these depressed prices. You had just this immense number of credits floating around, or allowances floating around, big oversupply in the market sitting on the various accounts of the compliance operator in this market. So I would say and there was a lot of discussion since 2013 how to fix this, how to fix this market, to create to make the UTS really an incentivizer for decarbonizing the European economy. And I would say the introduction of the market stability reserve in the system is really a before and after moment. So it really introduces a flexibility on the supply side. So it's a mechanism that reacts to the oversupply or to the supply of allowances in the market, and in an automatic manner it takes in or holds back allowances from the auctions, so to make sure that the market is balanced. Then we also had the Green Deal, the adoption of the climate targets for 2030, which of course then would, as the UTS is a key tool for Europe to get there, the cap of the UTS will have to be much steeper. So the supply will shrink going forward. So these two things, and also the prospect of the tighter supply, bringing in interest also from new players that have been absent from the market, so the financial sector, and with the energy crisis, high gas prices, which also a bullish driver. You've seen just this extremely bullish development in the EU carbon market over the past few years, starting from 2018, where prices tripled when the market we were expecting the introduction of the market stability reserve, and then since 2020 you see the price rise. The large dip here in mid 2022 with the invasion in Ukraine, I think was several reasons, but also like this uncertainty in the market whether Europe would be really standing by its climate targets in such a situation. But that has been no really backscaling or backtracking on the targets. No real signals that would happen. So as long as the targets and the policymakers stand firm on this, we will have this situation, which is our base case price forecast until 2030. So it is, of course, I mean, it's a modeled output and it's average annual prices until 2030. And the assumptions is of course really key here. We assume that the Fit for 55 package is pretty much the same as what was put forward by the Commission. So you will have the 2030 targets, you will have the cap reduction, and you will have the changes to the market stability reserve that is in that package. Also the increased renewable and energy efficiency targets. So what we in our base case, we expect for 2023 an average price of 70 euros. Right now, the price is, I just checked, a bit above 76, trading right now. And we expect a dip for the next few years. I mean, it's a combination of higher fossil fuel burn because of coal being brought back and coal phase-out plants being postponed due to the crisis, and the demand destruction with the lower industry output. There's also the discussion on the Repower EU at the moment, so which is partially going to be funded by selling additional allowances from the EU ETS. So taking allowances from the front, so from selling them now, so as to fund or accelerate the transition away from fossil fuels, and have money towards innovation and other purposes. So that is why we have this dip in the front. Then mid-decade, we assume in our base case that the crisis will become more normal and that the coal phase-out plants will resume. So lower fossil fuel, but then over towards the end of the decade, what really is the price setter is that industry sector will have to decarbonize. So it's reflecting the abatement costs of reducing emissions in the industry sectors. And this forecast includes, of course, shipping sector, which we expect to be included. It doesn't really, the inclusion of the shipping sector adds to the emissions in the scheme. It also will be an addition to the cap, so the supply side will also be adjusted. So overall, I mean, the shipping sector is a price taker. This is our expectations for the price until 2030. And shipping will be covered fully because they will have to buy allowances on auctions or in the secondary market. There will be no free allowances to the shipping sector. Of course, we have scenarios with more accelerated renewable energy, or a negative one with recession, lower GDP assumptions for a longer time. But I won't go into that now.
Thank you, Hege. Nico, what about financing the drive to decarbonization? Does financial innovation have a role to play in all this?
Yes, thank you, Alessandro. I think it does, and there are one main reason for that, and that is the projected cost of the drive to decarbonize shipping, which is estimated to be anything upwards of $1.5 trillion US. So this is going to require significant capital costs and will also affect how shipping companies are financed. What is interesting is that although initially climate change initiatives for shipping originated from the IMO, now you see different stakeholders in the industry taking the driving seat and actually driving the process of decarbonization, So we have seen that with different stakeholders, including banks, finance houses, trade associations, and even insurance companies. Probably from the finance front, the most well-known initiative are the Poseidon Principle, which is a consortium of 31 ship finance banks with 186 billion of US dollars of shipping loans. So their objective is to provide a framework for integrating climate considerations into lending decisions in order to promote and to drive the process of decarbonization. So the idea is that banks will monitor the carbon footprint of their portfolio of ships that they finance, and they will provide on an annual basis a benchmark compared to where they are versus where they would like to be if they were to meet the 2015 IMO target. So this is a very good initiative, and it is something that the market has embraced. We've also seen the use of bespoke financial instruments that have a green elements, and I'm talking here about green bonds, which are bonds specifically targeting financing or providing finance for a project with environmental credentials. That would be either a conversion of a ship to LNG fuel ship, or financing LNG fuel new buildings, or even sustainability-linked loans, which are similar in nature, but now the cost of the debt changes depending on whether the company meets some environmental KPI, something that is measurable and can be assessed in the market. And interestingly, sustainability-linked loans and green bonds accounted for 40% of the total bond proceeds that were raised in the market in 2021. And just one final thought here, and just would also like to echo what Fabrice and the captain mentioned earlier. The scale of the costs involved here is huge. So under normal circumstances, we would be talking about a very, very large infrastructure project. And it is the sort of the project that cannot be financed without governmental support, either in the form of public-private finance initiatives or in the form of providing R&D funds that will be used in order to test different technologies, to provide proof of concepts of the different approaches, and therefore provide support towards this very, very long but very virtuous as well journey. And that's it for me.
Excellent, thank you.
Thank you.
Sorry, there was a glitch with the sound.
Sure.
Excellent, and I think this is probably really the way to go forward. I'm conscious of time. I'm saying that we're on the hour, but I see some questions coming in the chat. I'll probably just start with one. Carbon appears to be a very expensive added cost. Ship owners and charterers would have to pass those costs on to the consumers. How aware are customers of how expensive this is? Gia, would you like to give it a go?
Yeah, I can try. How expensive it is? I mean, the key here is when will it come into the market? I think there's a lot of the larger charters on the tanker side, especially and also on the dry bulk side, they are very aware of what is coming here. Also, the owners are there. The larger owners are also very aware. We have helped a lot of them simulate the exposure, the coming exposure, how exposed they will, how that will impact their shipping program, whether they're a charter or a ship owner or even a financer financing ships. That being said, I think the greatest uncertainty here is who will be held responsible to pay. I think the proposal today is a bit, again, vague, as Hege said. It is polluters pay. It is the owner that still needs to report the allowances. But the key question is, will the owner be able to, by legislation, pass it on to their customers? Or would it be a commercial decision that would be need to pass on to the customer? So that I think that's the big key uncertainty for the charters and owners today on how this EU ETS will pan out. It will be an added cost, but it will be an administrative burden on the additional to the owner. The question is if it's the owner alone that would need to have that financial risk as well attached to this, to buying and managing the carbon credits.
Thank you, Geir. Nico, I see a question for you. How the drive to decarbonization will shape the industry going forward?
Thank you. That's a very, very interesting question. I think the consensus of the industry and also what is coming from our discussion is that it is going to change significantly the operational aspects of shipping. So if you like, my view of the future is that it is going to be priced, emissions are going to be priced in the market very much in some of the ways that were discussed here, but they're also going to affect how charters and how users or consumers choose their vessel, in the sense that it is going to become something very much similar to a credit rating. So like we see right now, the credit rating in order to choose between different investments that we make or in order to assess credit worthiness of counterparties, sooner or later we're going to have a similar rating, but looking at the carbon footprint and the carbon efficiency of different ships, and possibly expanding that into portfolios of companies. So I think that would be the natural next step for a fully market-based approach.
Thank you, Nico. Conscious of time, I'll just take the last one. It's on policy change. Ege, I would like to ask this to you. In the event that the IMO ultimately acts and introduce a market-based measure, how can we expect EU institutions to respond?
Well, I think that ship has sailed in a way. That this is coming. This inclusion of shipping in the EU ETS is coming. It's going to be part of the EU ETS directive. It is. It's not really dependent right now on developments in IMO, to my understanding. So I think this is pretty much a done deal for the moment.
Excellent. So thank you all. I think that this brings this virtual event to a close. Let me thank you, the audience, for joining us in this webcast, and to our speakers for sharing their insights. Thank you and stay safe.
Thank you.